Investors constantly navigate a dynamic landscape shaped by technological advancements, shifting consumer preferences, and intense market competition. Amidst these variables, one timeless concept remains essential for investment success. The intrinsic value of any financial asset lies in the present value of its future free cash flow. Great investors deeply understand this truth, focusing their analytical capabilities on identifying, measuring, and forecasting sustainable cash flow streams. This video examines free cash flow's critical role in value creation, exploring how astute investors assess company fundamentals beyond simplistic valuation metrics. The investment world evolves rapidly, as evidenced by the shrinking average lifespan of public companies from decades to roughly 10 years. Companies once deemed invincible can vanish swiftly due to technological disruption or shifting consumer demands. Kodak, BlackBerry, and Blockbuster illustrate how swiftly industry leaders can collapse. Amid these mutable realities, the principle that the value of an asset is fundamentally anchored in future cash flows remains immutable. This bedrock concept ensures that while the specifics of valuation models evolve, the foundational premise remains constant. Free cash flow, the cash available after covering operational expenditures and necessary investments, represents the lifeblood of value creation. Unlike earnings, which are subject to accounting manipulations and interpretations, cash flow provides clarity. Investors who grasp this concept evaluate businesses not on superficial metrics, but on their sustained capacity to generate genuine cash returns. Warren Buffett famously emphasizes free cash flow over reported earnings, underscoring its reliability as a valuation foundation. Industries traverse stages, from initial innovation to rapid growth, maturity, and eventual decline, each offering distinct implications for cash flow generation. Tesla's transition from aggressive growth toward profitability illustrates the shift from negative to sustainable positive free cash flow. Conversely, ExxonMobil exemplifies consistent cash generation typical of a mature industry with steady but limited growth prospects. Savvy investors adapt valuation models and expectations based on these lifecycle insights, accurately interpreting cash flow sustainability and risk. A firm's competitive position significantly influences the durability of its cash flows. NVIDIA's formidable moat within the GPU and AI industries safeguards its market share, pricing power, and long-term profitability. In contrast, Peloton's declining fortunes, exacerbated by weak barriers and intense competition, highlight the fragility of its cash flow. Investors adeptly dissect competitive strengths and vulnerabilities, enhancing forecasts of long-term value potential. Fundamental investors dissect underlying business economics, focusing on unit profitability, scalability, and operating leverage. Netflix's subscription model demonstrates superior economics through scalable distribution, recurring revenues, and margin expansion as subscribers increase. Conversely, WeWork's inflated valuation and subsequent collapse underscored its flawed unit economics. Rapid growth masked inherent unprofitability. Investors who scrutinize such economic fundamentals avoid superficial attractiveness in favor of genuine economic substance. Capital allocation proficiency dramatically impacts sustained value creation. Berkshire Hathaway epitomizes disciplined capital management, reinvesting earnings judiciously across diverse, profitable ventures, consistently enhancing shareholder value. By contrast, Meta's heavy investment in the metaverse highlights contentious strategic choices, raising questions about future returns. Astute investors prioritize management's proven ability to allocate capital effectively, shaping investment decisions around reliable stewards of investor resources. While fundamental valuation remains critical, behavioral finance and market anomalies suggest occasional disconnects between intrinsic value and market pricing, exemplified by GameStop's meme stock volatility. Efficient market theorists argue valuation discrepancies are short-lived, quickly corrected by informed market participants. Nevertheless, great investors exploit these temporary divergences, adhering to intrinsic valuation disciplines even amid market irrationality. Practically applying rigorous cash flow analysis positions investors to discern genuine value opportunities, enhancing decision quality, and mitigating speculative risks. Investment professionals must cultivate deep, fundamental analytical skills, increasingly valuable as market complexities evolve. Proficiency in interpreting intrinsic cash flow dynamics fortifies investment strategies against transient market distortions. Understanding value creation via free cash flow analysis remains a timeless investment imperative. Future analytical practices may integrate artificial intelligence and advanced predictive models, further refining cash flow forecasting precision. Nonetheless, core valuation principles endure, guiding investors through evolving market landscapes and anchoring investment decisions in substantive economic reality.